This voice is taken from an article with the title, How Does Inflation Impact Currency Pair Movements?, which has been published on TRADERTALKSNET. Inflation is a key factor in determining the value of a particular currency in relation to another. It can have a significant impact on currency pair movements, as it affects the strength of a currency and the exchange rate between two currencies. Inflation is the general rise in the price of goods and services over time. When inflation rises, the purchasing power of a currency decreases, meaning that more of it would be needed to purchase the same goods and services. This makes the currency less attractive to investors, who may start selling it off in favor of a currency with greater purchasing power. The impact of inflation on currency pair movements can be seen in the purchasing power parity theory. This theory states that two currencies should have the same purchasing power, which means that if the inflation rate in one country is higher than the other, the currency from the higher inflation country will become weaker. This will result in the exchange rate between the two currencies moving in favor of the currency from the lower inflation country. Inflation can also affect the exchange rate between two currencies through the interest rate effect. When inflation is high, central banks will often raise interest rates to try and curb it. This can make a currency more attractive to investors, as they can earn higher returns on their investments when they hold it. This can result in an appreciation of the currency, meaning that the exchange rate between it and other currencies will move in its favor. Finally, inflation can have an impact on currency pair movements through its effect on economic growth. If inflation is too high, it can lead to a decrease in consumer spending, as people will have less money to spend. This can slow economic growth, making a currency less attractive to investors. As a result, the exchange rate between the currency and other currencies can move against it. In conclusion, inflation is an important factor to consider when looking at currency pair movements. It can affect the purchasing power of a currency, the relative strength between two currencies, and the exchange rate between them. By understanding how inflation impacts currency pair movements, investors can make more informed decisions when trading currency pairs.